All right, so in this second part of our lecture, this meeting, I shall be focusing on how to do the calculation with some of the ratios. But I'll make sure that all the concepts that, you see, there'll be two things you will be requiring to find a ratio. There is a numerator and a denominator. So whenever we do some ratio, I would help you to find out the numerator and denominator from BP's statements. But a disclaimer is that all the companies in the world, they may use different phraseology, but they follow the same principle. So make sure that they will not be different in terms of principles, even though they might use different words or terminologies. So, of course, you have to be familiar with only one company because you are only analyzing one firm. You are doing a horizontal analysis. You are comparing companies with itself over time period. The first ratio, which the category of ratio, see the A category is called operating ratios. The word operating comes from operations. Operations mean functions. The firm functions on daily basis. So primarily, the purpose of this operating ratio is to find out that how well the company is using its resources on its activities, which it performs on nearly daily basis. How well is, remember I told you a firm consists of three things. The firm consists of financing, investing, and operations. Financing, money comes from investing, money goes to operations. How well it uses its resources, that the return it produces on investing is higher than the cost of financing, so that the company is adding value. All right, so in operations, primarily a job would be to check how well the company is utilizing its resources so that there is a wastage minimum and utilization the maximum. The first ratio is called operating return on equity. To calculate operating return on equity, the word itself is very clear. Operating return, it means we talk about operating profit. On equity, it means the denominator should be the equity. Which equity? Well, it's a shareholder's equity, right? And how do you find it? You be careful that, as I said, one purpose of this course is to get familiar with the different phrases the accountants use. Okay, I hate it, but that's a fact. Operating profit is of two types. This can be gross profit, gross operating profit, or it could be net operating profit. The slide itself shows. And how you get the operating profit? The operating profit is the revenue minus all the costs, which you subtract those costs which are only concerned about the company's operations. The gross operating profit is also called EBITDA. Which means the earnings before interest, tax, depreciation, and amortization. The earnings before interest, before you pay interest. The earnings that before you pay tax. The earnings before you minus depreciation. And the earnings which before you minus amortization. So that profit which you have already calculated, before interest, tax, depreciation, and amortization is subtracted is called gross operating profit. The net operating profit is only EBIT, which means the net operating profit is earnings before interest and tax. It means the net profit subtract depreciation and amortization. Depreciation is that when you buy some asset, some tangible, physical, seeable, touchable asset, material asset, you make use of it and you divide it over its working life. Imagine you buy some machine for 100,000 euros. And imagine that this machine's working life would be 10 years. It means that every year you will be subtracting 100,000 divided by 10 is 10,000 euros, yeah? So every year you'll be minusing 10,000, 10,000, 10,000 from the company's profits or revenue. This is called depreciation. Depreciation is discounting the value of the physical asset because we know that over time, the company, the asset would be worn out, will be used, and then we subtract that value. That's called depreciation. Amortization is very simple. Amortization is depreciation, but on intangible, non-physical, non-seeable assets. If your software, if you develop some computer language, and that language, there's no taker after 3 years. You know, it was very much in the vogue. People would study it, coding, these IT professionals, but after 3 years, nobody is using this language. It means that the value of this intangible asset is now zero. But this fall in the value will be called amortization. Depreciation is the loss of value on physical assets. Amortization is the loss of value of non-physical assets. One example, before I come to you, Felix. GlaxoSmithKline is a pharmaceutical company. They develop drugs, they develop some medicines. The WHO, the World Health Organization rule says that after 20 years, the product, the drug is introduced. After 20 years, it will become off patent. Off patent means anybody can copy the formula and manufacture it. It means that when GlaxoSmithKline develop a new drug and launch in the market, not the prototypes, but the real one, they know that after 20 years, there'll be cheap substitutes. People will just come and manufacture it, some local companies, and then nobody would pay them more price because these Glaxo products, they are high-end products. So they know that the working life of their research and development, innovation, is 20 years. So if they spend 1 billion on a new drug, then they divide 1 billion over 20 years and see how much is the deduction every year. And this deduction is called amortization. Why? Because the invention is non-physical. Research and development, developing a formula, developing a, whatever you call it, is a intangible. Same way, many media products, when they launch some things, they charge money, but after some time, it becomes just for the public view. That is also called, the amortization. So as a rule of thumb, depreciation is only valid for the physical deduction in the value of assets, whereas the amortization is still the fall in the value, but that belongs to that concerns to the intangible assets. Okay, that is called amortization. For a company like BP, I don't see many intangible assets. But if it's a media company, if it's an R&D firm, if it's a pharmaceutical, if it's an IT firm, I can imagine that the block of intangible assets would be pretty big. But as a rule, we know that the depreciation is fall in the value of physical assets and amortization, the non-physical assets. Yes, Felix.
Are the depreciation laws the same all around the world? Because in Germany, companies use the law to save a lot of taxes.
Yeah. It differs from each country's jurisdiction. Yeah. It depends upon, and even in a country, the law gives you the choice. Like in many countries, you can depreciate computers, the new computers, in 3 years or 5 years. So they give you some time window. Now it's up to the accountants. Those who depreciate within 3 years, then they would show more expenses and less profits. But those who depreciate in the same country in 5 years would show comparatively more profits and less expenses. Yeah?
The difference for when you do it 3 or 5 years, or when you do it yearly. Depending on the price product.
Yeah. Yes.
So 500 euros, you can just depreciate everything.
Yeah, if you buy something for 500 euros and you have a working life of 5 years, well, there are many methods of depreciation calculation, which I shall discuss with you in a new topic, when we shall discuss that how the companies have some cheating motives and how they manipulate the data. Even though some cheating motives we shall discuss in this topic as well. So sometimes you use different method. In the reality, everything is same, but just by changing the different method, you can outwit, you can fox the regulator or the tax man. All right. So yeah, you can do that. So even the same asset, same bought, the same thing is bought, same period, same, but by following a different formula, you can do some creative accounting, or you can manipulate the data.
Do we discuss how that works?
Pardon?
Do we discuss how that works?
Do we discuss all?
How it works in Finland, this depreciation.
It depends upon the type of assets. Yeah. The fixed assets, the working life is longer, right? And there's always a room for appreciation also. Like for example, if we have this young building, yeah, we have two things. We have the superstructure and the land. It would be almost naive to say that the land is depreciating, because over time the land price goes up, right? But the superstructure, the building, that is depreciating. Because the building becomes old and then there's a lot of problems, and sometimes there is a air problem, moisture. So I would say that in that case, the depreciation, the working life of a building in Finland is comparatively smaller than in many other countries, because of many natural, reason. The moisture is a big problem. Yes. So we have two concepts here. EBIT, and the second thing what we require, I recommend you that when you calculate this ratio, go by the net operating profit. So in the numerator here, you have the operating profit, right? I recommend you to use net operating profit, which is minus depreciation, minus amortization. And then you divide by the shareholders' book value of equity. It's very simple. The shareholders' book value of equity is very, very simple. All you need is subtract total liabilities from total assets. And that is called, remember the last lecture? What is it called? What is assets minus liabilities called? Capital. Which capital? That capital which belongs to shareholders. All right. Remember the equation we did? Assets is equal to liabilities plus capital. Yeah, last week. So the book value of equity is very simple to find. All you need to do is total assets minus total liabilities. Okay. So if I can show you It means that on numerator, we need EBIT, right? And we need to divide it by, divide by what? Divide by shareholders' equity. And where this information come from? This information come from, the first information come from the income statement. Look, profit before interest and taxation. Profit before interest and taxation. Many companies use the word profit and earnings as interchangeable. So EBIT or PBIT are same. EBIT means earnings before interest and tax, and PBIT means profit before interest and tax. Now here it's very clearly written, the profit before interest and tax is 9474. Yeah. This is company's net operating profit. Net operating profit or EBIT. Okay. And the denominator, we need the shareholders' equity, which is here. Go to the company's balance sheet. The balance sheet is here. Please be careful that you may struggle when you do this thing, that where this information come from. So listen carefully where this information come from. Look, we have total assets, 276,515. We have total liabilities, 176,111. And guess what? This information is already given to you here. Okay? This information is already given to you. And if you believe me, the shareholders' equity is also called net worth or net assets. And you can see that in this case, they are using net assets. So net assets, net worth, or shareholders' equity are synonyms. And I have explained here that number 2 point is this superscript 2. And I explained here that book value of equity is also known as net worth or net assets. All right. Generally, this is already given. Like in this case, I didn't even have to calculate it. We just have to pick it. Right. But otherwise, this is equal to total assets minus total liabilities. Okay. And total assets, both current and non-current assets, minus total liabilities, which means current plus non-current liabilities. So everything together. All right. Every company, every living company should have the shareholders' equity positive. Because if it is negative, it means liabilities are more than assets, then company has no right to exist. Then the company has an existential threat. Hence, company becomes bankrupt or insolvent. All right. So every living company have a positive book value of equity. So the first thing, numerator, is called net operating profit, and the information comes from the income statement. And what will you get from the income statement? EBIT. All right. And I didn't write PBIT, but just when I saw the statement of the company, it says not the earning, but they use the word profit. So EBIT or PBIT are same. Earnings E, profit P. That's it. The operating return on equity represents operating profit before tax as a percentage of the book value of the equity. And one thing I would like to say, that operating profit is a very pure measure of profitability. I didn't take gross profit. I didn't take net profit. I did not take them. Because when you calculate your net profit or the profit after tax, the final profit left over, you not only subtract the operating expenses, but you also subtract interest and tax. Remember, interest and tax, the company pay. Nobody denies it. But interest and tax are not company's main operational expenses. The company's operational expenses are raw material usage, labor charges, the fuel, electricity, transportation to make the shipments of the raw material in and the finished goods to the supply chain network. Interest is an expense. You pay on debt, but it has nothing to do with the company's operations. Therefore, we are not interested in just profits. We are interested in those profits which arise purely because of the company's operations, operational performance. And since the category of the ratios is operating ratios, then I have another reason to take operating profits. Operational profit. See, if you check the financial statements of the company, and you go back to the income statement, there are at least there are several measures of profit: profit and loss before interest and taxation, profit and loss before taxation, profit and loss for the year. So there are three different measures of profit. But what we are interested in is operating profit, which is EBIT, earnings before interest and tax. So it's very important that you pick up that bit of information which relates to you, not just anything. Okay. So many people argue that why we take operating profit, because they don't deduct the non-operational expenses. Interest is nothing to do. When you run your factory, interest will never show up. Tax will not show up. These are somewhat additional expenses that have nothing to do with your factory environment expenses. They are not those. In the operational profit, we only deduct those expenses which directly concern with your operations, daily operations. The next one is return on capital employed. Once again, the numerator is operating profit. Needless to say, we shall only take net operating profit. And net operating profit is also called earnings before interest and tax, or like you just saw in the context of BP, British Petroleum, that they prefer to use the word profit rather than the earnings, so PBIT. So the numerator remains same, but there is a small change in the denominator, that instead of only equity, they use total capital employed. How many types of capital we employ? If I want to start a firm and I approach you as my prospective investors, how many types of capital you people can invest in so that I get financing from you? And then with this financing, I buy the assets and I use the assets in such a manner that I produce 8% return on profit. And let's say my agreement with you is 6%. So I earn 8%, 6%, 2% net profit I get, which means my operations were successful. My point is that what is meant by total capital employed? Remember the example a couple of weeks ago that I approach you people, half of you want to invest in equity half of you give me debt. Then those who invest in shares, they become a partner of the company. So they will be with the company in every thick and thin. More profits company earn, you become richer. Company have losses, you also lose. But with the other set of people, I keep an arm's length distance. They give me capital, but they're outsiders. I borrow from them. They lend me money, I make use of the money, but I agree that I would pay you the fixed rate of interest. The company could be riches, rolling in riches, but you will not claim more money from me than I will still give you the fixed interest rate. And if the company is in a bad shape, having losses, I still pay you fixed interest rate. It means that the total capital employed of the company includes the debt capital and the share capital. Remember, these things are very important. You must understand these things right now. Okay, so keep yourself active and awake, because if you miss out these things, it can be a little bit complicated for you to search for them. That there's two types of capital. In the previous formula, if you see, the denominator was shareholders' capital. It means I'm only dividing the operating profit by those people who invested in the shares. All right, but we also have the debt capital. So when I add total capital, equity plus debt, it becomes total capital employed. All right, and once again, the numerator would be our net operating profit, which is EBIT or PBIT. Okay, so the only thing we require to apply the second formula is the total capital. Okay, and total capital is total liabilities plus total equity. Have you seen this equation before? What this equation means? Assets equals liabilities plus capital. It means liabilities is the money which I owe to people who give me loan, yeah? And capital is those people who invested the money in the company. They took risk. And when you put them together, it becomes total assets. It means that instead of first taking the data of liabilities and then adding to the capital, I can straight away see the total assets. This is my total capital employed. This is the total capital employed. And this includes debt plus equity. And I mentioned even in the slide that total capital employed is basically well, I should have said it somewhere that total capital employed is your total assets. Or maybe I said, yeah, total capital employed is. Maybe in the next ratio I said, but I should have said here also that total capital employed is total assets. Right? Higher the ratio, better it is. If a company over time, the total capital ratio employed is getting better, it's a good news. Mm-hmm. I have calculated all the ratios which you are supposed to do in the BP example. And you can see that I have the operating ratios liquidity ratios, solvency ratios, and the profitability ratios. And you can see here that the company's operating ratios are changing over time. So I have got these templates for you, right? So you are supposed to do these things by yourself. It's so easy, believe me, and you will fall in love when you start doing it. You'll be good. Yeah. Remember, this is a very important skill to understand. I mean, it's always, of course, not everybody is interested in these things, but you must understand these concepts if you want to. You can do marketing job or as a IT professional job, but if you are an entrepreneur, you can't run away from finance. All right. It can be very expensive to hire the financial services from an outside agency. And who knows that they take a lot of money and don't provide you the good services. You should be capable enough to do this financial analysis by yourself. The third ratio is also is quite simple, but this time what we do is that we don't divide any profit with the total capital employed. We divide the revenue by the total capital employed. So we want to see that how many times you must, so for example, if your revenue divided by total capital is 0.20, it means that you must earn the revenue 5 times so that you are able to recover the cost of your investment. Okay? So if this ratio is improving, it shows that you are making a fantastic use of your resources. But then there is a small catch. The catch is that super clever managers, not in the positive way, but in the negative way, can they cheat the investors? Yes, they can. The one possibility is that if you look at this ratio, revenue divided by total capital employed, in how many ways I can increase this ratio? Well, the honest, positive, good way is that the numerator should go up and the denominator remains same. But if I want to do some data manipulation and at the same time show the better performance to the investors, that when the revenue is going down, I can decrease the total capital employed. So for example, last year, revenue was 200, capital was 500, the ratio was 0.40. It means you can get 40% of the revenue of your total investment. It means 0.40 means you need 2.5 years to cover up all the cost. But imagine what happens here. In 2017, the company's profit goes down. And what the company can do, what is the opposite of capital? When you bring assets in, it's called capital. But when you take away the money out of the business, it's called withdrawal. So what company can do is that instead of, they can sell some factories and buy some villas or some holiday home in the name of some managers. So basically, the company is hell bent upon shrinking its resources. And imagine they can sell their milch cows, they can sell all their great assets, all the technology, and instead buy some flimsy investment investments in the name of managers, so that the capital is 300 now. There's 200 capital disappearing from the company's accounts. And guess what happens? The ratio is 0.50. At the ground level, the company is having a horrible performance. Their operational performance in real terms goes down. Here they are cheating investors, right? They have siphoned off 200 without the knowledge of investors. They don't even know where this money disappears. But when you find the ratio, it comes to be 0.50. And then they are highlighting, propagating, advertising in all the financial media, in all the interviews. Look at our ratio. Look at our asset turnover ratio. We have made an improvement, whereas the company's performance has gone down. This is why I was telling you that take the information. If some layperson reads the financial statements, I can understand that the company managers can cheat them, but you being the finance students, you should take this data with a pinch of salt and find out that what exactly is on the surface. All right. Now, apparently this number is better, but the reality is dismal. The company is in a collapse. And this is exactly what happened for Enron. Enron 2001 is a classic case of bankruptcy, and that was not the only case. Soon after Enron, WorldCom failed, and then after a few years, Lehman Brothers failed, and this is exactly what was happening. If you see the quarterly report of Enron, 2 months before its bankruptcy, its operating profit ratio, its asset turnover ratio is showing remarkable growth. Remarkable, not even minor growth, but splendid growth. But then nothing could stop the company from bankruptcy because nobody was knowing that, hey, where these numbers come from. Okay. So take this information, and this is exactly, remember I told you, we discussed last semester in economics, agency cost theory. The agency cost is that when the manager's interest deviate from the company's interest. The shareholders want something else. The managers want something completely opposite. So there's a conflict between these two sections. And who bears the brunt? Who suffers? The company suffers. And this loss, this suffering which companies inflict, which it undergoes, is called agency cost. This is a classic case of agency cost. You are able to mask a reality. You are able to hide a reality. All right? And you are giving a positive pictures of the company. Now, what is this? This is ultimate loss to the company. This is the agency cost. Because it happens. Managers are doing these manipulations without telling anybody. Shareholders are happy. Oh, great. There is an improvement. But this is not the truth. Agency cost, agency problem. Okay, Walter, you have some?
Surely this can't last for long. It's basically like corporate suicide, right?
Yeah, yeah.
How did it last so long with Enron?
For Enron, it was a very interesting thing. I tell you what happened in case of Enron. Remember, Enron was highly politically connected. All the Republican and Democrats, they were so close to Enron. Right? Kenneth Lay, the president, he was a very big name in the companies, in the political quarters. They would give donations, what you call as a election fund to all the political parties. What they did, the company opened several private companies under its name. Enron was a public company, listed company, but it opened many fake companies. And do you know how many fake companies they opened? Nearly 900 fake companies. And then they started borrowing money in the name of those fake companies. So money was coming in, but nobody knew that this is a liability. So what they were doing, because see what assets is equal to liability plus capital, right? They were not showing the liabilities here, but the assets which they buy with those liabilities, they would show. And then they would show that this money belongs to the investor, the shareholders. So the equity's value was overvalued. It didn't exist. And this they did for at least 3 years consistently, right? But ultimately, you are right that you can't do it. But the problem is that you can't do it for a long time. But it still gives you a lot of leeway. You can transfer millions of dollars from this account to that account. It doesn't take too long, right? But ultimately, what happened? The company became bankrupt. And this is even more dangerous when these things happen in connivance with your auditor. The auditor's job is to stop these things. But when the auditor is advising you to do this thing for the extra money, then it becomes even more clumsy and more diabolical, more dangerous.
In the example of Lehman Brothers, how is it possible that nobody saw that the capital was dropping? If that was the case, and the capital was dropping so dramatically in short time span?
Yeah, two reasons. When Lehman Brothers bankruptcy happened, the regulatory system in the US was just recovering from Enron. Remember, Enron shook the world. Enron shook the whole corporate empire. The American lawmakers were still recovering from that shock. And they were still in the process of making new regulations so that the things don't happen again. They were paying too much of attention in writing new rules. But before they could implement, Lehman Brothers happened. And secondly, Lehman Brothers transferred many funds from one account to another account within the umbrella of Lehman Brothers. So they were saying that they are only transferring money from the main company account to their subsidiaries accounts, but the money was going elsewhere. Who knows where this money was going on? Okay. So this is the reason why they were able to justify that they are only transferring from one account to their subsidiaries accounts, but this was not the case. They were giving lots of what we use a word, there's a phrase for it, subprime loan, that the interest they should charge should be 5%, let's say, but they were giving the loan to woo the customers from the other banks, and let's say 3%, right? So you can't sustain like this for a long time. Eventually, you can't sustain, right? And that was a time when the housing market in the US was collapsing. So many companies, there were many wrong things which Lehman Brothers did, but Lehman Brothers also failed because all the people who took money from Lehman Brothers, they didn't return it, and they became bankrupt. So let's say you give loan to 100 companies and 50 of them become bankrupt. You will also be suffering from them. So that bankruptcy will also have effect on you. So not only your own bad policies, but the clients who don't pay you will also speed up your issues, problems. That's what happened to Lehman Brothers. Right, so this is the asset turnover ratio, which I thought I should discuss with you. Once again, there are some good and bad reasons for these data things. Please go through it. I want you to read it, this slide, and go through it thoroughly. And then at the end, I question this in quote unquote, I copied and pasted some text from Wienerberger's company's annual report. And then when you read this report, could you please find out that there is something fishy here? There could be good reasons of improvement, but remember, in finance, in business world, never, whatever course you study in business studies, marketing, finance, entrepreneurship, anything, wearing the spectacle of skepticism. No, skepticism, sorry, spectacles, it's a tongue twister. Wearing the, I could use some simple words also. Wearing the spectacles of skepticism is very important. So wearing the glasses of the air of suspicion is very important. There are two kinds of risk in business. One is upside risk. Things can turn into a bonanza. That's an upside risk. If it happens, good luck. You're great. But never recognize the upside risk. Always keep in mind the downside risk. Upside risk, if it happens, lucky you are. But always be cautious. Always go for the downside risk. Whenever you make some planning, always go for the downside risk. Don't take success for granted, but take the losses and the problems already in your mind. All right? So it's very important that you see everything in the business life with the air of suspicion. Once again, I'm not saying that you start becoming conspiracy theorists, but it's always good to have this kind of skepticism. Okay, so